Welcome back, everyone, to Abe Capital Management's video series entitled Moving Forward by Looking Backward. In this installment, it will be part two of a piece entitled Can Negative Be Positive? In the preceding installment, we discussed the growth of debt across the globe as well as the historic decline in interest rates. In this installment, we will focus on some of the impacts of these two huge trends in the global economy. We'll get into some of the more dubious examples of risk taking in the capital markets, as well as begin to touch upon our broader concerns, which will be more fully discussed in the next installment. Before moving into the material, I'd like to ask that everyone take note of the disclosure language. Please note that this is for informational purposes only, and please consult your financial advisor before making any investment decisions, since this material is not tailored to any one particular individual situation, and Abe Capital Management's views may change as new information becomes available, and we may not be able to provide an update should this happen. Thank you. Previously, we discussed how central banks were purchasing long-term government bonds and even some corporate bonds. But some central banks have gone much further. Here on the left, we can see the Bank of Japan owning upwards of three-quarters of the country's exchange-traded funds, or ETFs. On the right, we see that the Swiss National Bank has a sizable allocation to equities, especially U.S. equities, amongst others, up from 27 billion to 93 billion over the past 5 years. Visible in the chart on the left, at one point, the central bank bond buying frenzy actually pushed $1 trillion in corporate bonds into negative yielding territory. So it could be argued that investors were ascribing a negative level of risk to these businesses. So this implied not that these corporations had some level of risk, or maybe even low risk, but actually negative risk. As the chase for anything with positive yield gained momentum, at one point, U.S. corporations, as you can see on the chart of the right, accounted for 94% of global yield and investment grade corporate credit. On an aggregate basis, the U.S. became the corporate allocation of last resort for those still believing that corporations had business risk. But as you can see on this slide, nearly 50% of U.S. investment grade bonds in corporates were only one notch above junk credit. Perhaps this is why they represented so much of the global investment grade yield, but it does make you wonder how capital allocators felt when they were underwriting an investment grade corporate index at less than 3% pre-tax yield to maturity for an index where companies where the median holding is just one notch above junk status, the average maturity is 11 years in the future, and where we might be at the top, not the bottom of an economic cycle. We'll discuss the impact of underfunded pensions on this dynamic, as well as the potential risk in our current socioeconomic construct to municipal finance in a future presentation. But this just seems like capital chasing yield without a firm grasp of the underlying risk that they were actually assuming. In another sign of potential irrationality, potentially driven by material central bank intervention in financial markets, is the recent issuance of 100-year bonds to Argentina and Austria. First, in less than 200 years, Argentina has defaulted on its debt 6 times. The most recent experience was only 5 years ago. So to lend them money, period, is a questionable endeavor. To do so for 100 years is either the quintessential greater fool theory allocation or just plain foolish. Now, in such a low rate interest rate world, perhaps the argument can be made that you'll capture enough on maybe a 7% bond in the next few years, and recovery rates will be decent enough even in the case of a default to justify such an allocation. Nevertheless, it strikes me as an allocation of capital that someone only makes with the hopes of selling to a greater fool. Within roughly 2 years post that issuance, it had declined approximately 60% in price. Alternatively, around the same time in 2017, the Austrian government was able to borrow at roughly 2% for 100 years. Due likely to European Central Bank intervention described above, interest rates have continued to decline in Europe, and the original investors in these 100-year bonds have nearly doubled their money in 2 years, and the yield currently is below 1%. I think these examples aren't a risk to the financial system itself, but highlight some of the greater fool and trading mentality that is currently surrounding the risk-free component of our global financial system that underpins, as Warren Buffett describes, the most important variable over time and valuation. Secondarily, the duration or price volatility for changes in interest rates is much higher at low interest rates than at higher interest rates, all other things being equal. And this might impact how one considers approaching a credit portfolio in the future. We anticipate discussing this more in an upcoming video on financial planning and broader asset allocation, but figured to give it a little taste of that right now. There is a bit of a self-fulfilling, self-reinforcing element to all of this, which is reminiscent of Hyman Minsky's stability breeds instability thesis. The more that central banks have both kept short-term rates at historically ultra-low levels for an extended period of time, while simultaneously purchasing various longer duration assets without causing huge risk to emerge in the credit markets increasingly are made to believe in the omnipotence of central banks. The central banks become more embedded in the theories that they're putting into practice because no issues have arisen, and investors get more comfortable that something that was at one point considered highly unorthodox and maybe only to be used in extreme circumstances is now actually a sign of safety and stability in the markets. Low rates actually make debt sustainable, and the lower rates go, the less interest burden for debtors, which enables more debt assumption. Without any meaningful inflationary pressures outside of asset markets, investors chase what real returns they can find, and even at times gladly assume negative real expected returns in hopes of capital appreciation, because rates sometimes are more negative, can become more negative, or because there actually is not really much of a good alternative. Perhaps the approach of central banks is the right one, and perhaps investors are allocating capital wisely based on their existing choices. But skepticism around this as a permanent condition is probably warranted, since it seems to engender elements of irrationality. As the two charts on this slide indicate, many companies try to convince Wall Street that they are profitable when they're actually not profitable by conventional standards. They do this by reporting what's called adjusted EBITDA. And without getting into details, EBITDA itself is kind of a bit of a shorthand for profitability that ignores stuff like interest expense, maintenance capital expenditures, and taxes. But adjusted EBITDA takes this one step further to exclude even things like parts of employee compensation, like stock options, or effectively excluding recurring costs to restructure parts of a business. So deals and profitability are increasingly measured using metrics that we might have in a prior era not accepted as a fair measure of profitability. Now, as long as these metrics are accepted by risk takers and companies continue to access capital markets through cheap financing, fundamentally unstable conditions are likely to be perceived as stable. This brings me to the chart on the right, where a significant percentage of businesses do not actually generate enough cash flow to cover their interest expenses. But in a world where capital is abundant and the cost is relatively cheap, these businesses are actually more likely to stay around by getting infused with more capital. And so there's a bit of an irony here, since many people say, or maybe a circular thinking, since many people say that low rates are justified because of low inflation. But when non-profitable ventures, often without much of a trajectory to profitability, remain in business, this actually leads to additional capacity in industries and irrational actors who can put pricing pressure on their more profitable competitors. So this takes away pricing power from businesses, and that actually itself is deflationary, which supports the rational lower rates, which keep many zombies in business. As we think about the sustainability and risks of this current debt cycle, I want to briefly discuss two key matters. First, is when we think of key metrics like debt to GDP, it's important to realize that the creation of debt typically also creates GDP. It's both the numerator and the denominator. Because debt usually goes to fund something at that time. It's a new brick in a building, a new police car, a subsidy payment for medication. But unless that new building or police car or medication results in a good return over time and isn't a low return or misallocated capital, the debt continues to exist, but that source of revenue associated with its creation might not continue, especially in the same way compared to the year in which it's created. So the question then becomes, how productive is that incremental debt growth? In this chart, you can see the average ratio of GDP to debt in the largest global economies. In column A, it illustrates the ratio in 2007 to 2008. In column B, it illustrates the ratio in 2017 and 2018. What we can see is that across all of these major regions, but especially in China, the productivity of debt is in decline. Specifically, debt is roughly 17% less productive than it had been at the time of the prior cycle. Now, maybe this is a function of the government taking a greater share and their objectives are less driven by economic productivity and more by social welfare. Nevertheless, it appears we're getting less bang for our buck. Or if you're in Europe, your euro, or if you're in Japan, your yen. This brings us to point number two, which happens when what happens when the next recession rolls around. As we saw, central banks have much less room to lower interest rates to increase growth unless they move firmly into negative territory, which has huge uncertainty and risks associated with it. I don't think they really would like to do that, all things considered. The hope would be on the fiscal side. But in terms of fiscal policy, it appears that government spending or investment more broadly through increased debt burdens is less likely to generate the type of GDP growth that we might have benefited from in last cycles. So the question concern that Abe Capital Management has consistently raised with clients over the past few years isn't when a recession might come, but what is the stabilizing mechanism or mechanisms at the time of the next recession? Since it appears that the traditional approaches of lower interest rates at central banks and more fiscal spending by governments have a lot less firepower than in previous cycles. So when obligations like the 120 trillion in estimated US unfunded liabilities that are illustrated in this chart kind of at the bottom cross paths with the demographic trends which we've described in prior presentations, the growth in debt might accelerate. All sorts of payments and pension obligations and what have you, Social Security, Medicare, Medicaid. And this is especially true if we're getting less bang for our buck, so that we might need more bang, meaning more debt creation, to get the same buck, being GDP, as before. In summary, as we look forward to the next installment of Moving Forward by Looking Backward, where we start to tie this kind of all together by looking at how the intersection of lower structural growth and increasing but less productive debt might collide, especially during the next downturn, with a historically extreme concentration of wealth, as can be seen in the slide below, as well as historically elevated corporate profits relative to real wage growth. Abe Capital Management believes that this creates both risks and opportunities, and we'll start to get into those more in the following presentations as well. In the meanwhile, I'd like to thank you so very much for your time and attention today. I hope this was interesting, and I look forward to sharing the next installment of Moving Forward by Looking Backward in the near future. Thanks again, and have a good one.